Welcome to the Deep Dive. We're the podcast where we take a whole stack of information, really slice through it, and pull out the key nuggets to help you get informed fast.
That's the goal.
Today, we are plunging into something that, well, it grabbed headlines everywhere just recently, the June 2025 U.S.-Iran military confrontation.
A major event, no question.
And our mission here for this deep dive is to really dissect how those intense geopolitical tremors specifically shook global stock markets.
Yeah, we need to look beyond just the headlines.
Exactly. We're going to unpack the market reactions, to the nuclear facility strikes, the retaliation that followed, and then that ceasefire announcement.
And try to figure out what the market's response tells us about how geopolitical risk actually gets priced in, or maybe what it doesn't tell us.
Right. And to do this, we've gathered insights from quite a range of sources.
Yeah, we've pulled from the Council on Foreign Relations, CNN, NPR, NBC News, Al Jazeera, CBS News, even Fox News Digital, trying to get that comprehensive picture for you.
Okay, so let's unpack this. To really get how the markets reacted, we need the backstory first. The historical context is huge here.
Absolutely. This wasn't just out of the blue.
No, relations between the U.S. and Iran, they've been tense for, over 40 years, going way back to the 1979 Iranian Revolution.
That's right. And Iran's nuclear program itself dates back to at least 1957.
Mm-hmm.
But efforts to actually develop weapons, those really ramped up in the late 1980s. And you had key moments, like back in 2002, when Iranian dissident groups exposed hidden nuclear sites. That really put it on the map internationally.
And the sanctions started biting hard then.
Oh, yeah. By 2015, international sanctions had caused, believe it or not, a 20% contraction in Iran's economy. Just staggering pressure.
And that pressure, combined with, a different Iranian president at the time, that paved the way for the 2015 nuclear deal, right? The JCPOA.
The Joint Comprehensive Plan of Action, exactly. It was meant to curb Iran's nuclear activities, and in return, they'd get sanctions relief. It really did feel like a potential turning point.
But it didn't quite stick, did it?
Well, Iran did largely stick to it initially, but then the U.S. pulled out in 2018 under the Trump administration and reimposed those tough sanctions.
And that had major consequences.
Huge. It triggered Iran's worst economic crisis in 40 years. It emboldened the hardliners there, and you just saw tensions ratchet up steadily.
Right, things like the drone incidents in 2019.
Exactly, and the U.S. killing of Qasem Soleimani in January 2020. These weren't isolated things. They were building blocks.
All leading up to June 2025. So fast forward to June 13th, 2025, Israel launches these unprecedented airstrikes.
Yeah, citing an existential threat. They hit key nuclear sites like Natanz, military bases, and tragically killed a lot of Iran's top military leadership.
Including the commander-in-chief and the IRGC commander.
Right, and the U.S. quickly said, we weren't involved in this initial Israeli operation.
Okay, but then, just a few days later, June 21st, the U.S. does get directly involved. And this is where it gets really interesting for the market dynamics.
That's the pivot point. U.S. B-2 stealth bombers hit 3 of Iran's most fortified underground nuclear sites, Fordo, Natanz, and Isfahan.
And they use those massive bunker buster bombs, right? The 30,000-pound ones.
First known operational use of those specific munitions, yeah. President Trump declared the facilities completely and totally obliterated, called it a spectacular military success.
But the picture wasn't quite that clear, was it? There was a lot of conflicting information flying around immediately.
Oh, definitely. And that ambiguity, that itself is a huge factor for markets, isn't it?
Because markets just hate uncertainty.
Absolutely. So you had Trump saying obliterated, but Iranian officials were immediately downplaying it. One lawmaker said the damage was quite superficial.
And an advisor claimed Fordo was evacuated anyway.
Right, claimed it had been long evacuated.
Yep.
Later, satellite images showed, yes, direct kinetic impact at Fordo, but maybe Iran had reinforced entrances, maybe moved material. And the IAEA, the International Atomic Energy Agency, they later confirmed the above-ground part of Natanz was destroyed, but not the critical underground stuff. And crucially, no increase in off-site radiation.
So this flood of conflicting info, that must have just poured fuel on the fire in the markets.
Totally. Traders talk about information arbitrage opportunities in situations like that. It amplified the volatility massively within the trading day.
People weren't just trading facts, they were trading narratives.
Exactly. Different news hits, the market swings, very erratic.
So, okay, backdrop established.
Yeah.
Strikes, conflicting reports. What was the immediate global market reaction? Show me the financial ripples.
Swift and significant, especially, as you might expect, in energy market.
Oh.
Oil. U.S. crude futures just soared, Right after the news broke, they jumped around 8% that morning.
8% is big.
But overnight, it had peaked at a 13% gain. 13%.
Wow, 13% overnight. That is a massive shockwave for a commodity like oil. What drove that specific extreme reaction? Just general fear.
It's more than general fear. It's the direct repricing of supply disruption risk.
Yeah.
You have to remember, Iran is a major oil producer,
How much do they export?
nearly 2 million barrels a day. But the market's worry wasn't just Iran's barrels, it was the whole region.
Ah, the neighbors. UAE, Kuwait, Iraq.
Exactly, all major producers right there. And the big fear is always disruption to shipping, especially through the Strait of Hormuz,
The choke point.
the ultimate choke point.
Right.
Almost a third of all global seaborne oil goes through there. Any hint of trouble.
And prices spike. So that 13% wasn't just panic, it was the market trying to calculate the odds of Hormuz being disrupted.
Pretty much. Some models probably put a pretty high probability, maybe 60% even, on at least temporary disruption. And you saw that in the options market too. Implied volatility on crude options went through the roof. Traders were betting on more wild swings.
Okay, so oil takes the immediate hit. What about broader stock markets globally? Was it just sell everything or more nuanced?
It was generally a clear risk-off move across the board.
Yeah.
Global stocks dropped. Japan's Nikkei index, that fell over 1.5%. South Korea's KOSPI was down 1.2%. So broad regional concern, definitely.
But were there differences between sectors?
Oh yeah, if you dig deeper, you see interesting stuff. Defense stocks, for example, often get a little boost. Investors anticipate more government spending,
Makes sense.
But then airlines, tourism, they usually get hit immediately. Higher fuel costs, travel advisories, that kind of thing.
And the VIX, the fear gauge.
Spiked. Jumped nearly 30% right after the U.S. strikes. That really underscores how quickly systemic risk gets repriced.
And people ran for safety.
Textbook flight to safety.
Mm.
U.S. Treasury bonds rallied, so their yields fell. And safe haven currencies like the Japanese yen, the Swiss franc, they strengthened. Investors were just looking for cover.
Okay, so that's the U.S. strike reaction. But Iran retaliated pretty quickly, didn't they? Though maybe not as strongly as feared.
Right. Iran launched what President Trump called a very weak response. He even publicly thanked them for giving advance notice.
Where did they hit?
They attacked the Al Udeid Air Base in Qatar. Huge base, thousands of U.S. troops. But thankfully, no casualties. It had been evacuated.
And they fired missiles at Israel, too.
Simultaneously, yes. Explosions heard in Tel Aviv, Ramley. But Israel's Iron Dome system intercepted a lot of them.
So how did the market react specifically to this retaliation? Did oil fall back down?
It was nuanced. Oil prices did pull back a bit from that 13% peak, but they didn't collapse back to where they started.
Ah, so some of the risk premium stayed.
Exactly. It suggests the market thought, okay, maybe not all-out war right now, but the underlying instability risk. That's still higher than it was before a new baseline was set.
Got it. And what about the diplomatic side, the institutions? Did Iran change its stance with the IAEA?
It did. Iran's parliament quickly passed a bill suspending cooperation with the IAEA, banned inspectors unless security was guaranteed.
Which raises big questions about transparency going forward.
Huge questions.
Yeah.
And from a market view, that just adds another layer of long-term uncertainty about Iran's nuclear path, which investors have to factor in.
Okay, so tensions remain high, but then we get this glimmer of de-escalation, the ceasefire announcement.
Yes, June 24th, President Trump announces a total ceasefire between Iran and Israel. He even suggested calling it the 12-day war.
Catchy, but did Iran and Israel confirm it right away?
That's the key. At the time of the announcement, neither had publicly confirmed it. And while Trump talked about maybe a new nuclear deal, Iranian officials sounded pretty hesitant about returning to talks anytime soon.
So how did markets react to the ceasefire news itself? Did things calm down?
Well, here's what's interesting. Our sources didn't really point to immediate, dramatic market reactions to the announcement itself.
Why do you think that is?
A couple possibilities. Maybe the worst of the geopolitical risk premium was already priced in during that initial shock and the limited retaliation. Or, perhaps more likely, markets were skeptical.
Waiting for confirmation.
Exactly. Waiting for clear, multi-party confirmation, not just a unilateral statement. It really highlights how credibility and consensus matter when pricing de-escalation. The market needs to see peace, not just hear about it.
Okay, so pulling it all together, what does this teach us? What does it mean for you, the listener, about how geopolitical risk gets priced? It feels complex.
It is complex, but there's a clear pattern, or maybe several patterns. Financial markets, especially sensitive ones like energy, but also global stocks, they react instantly and sharply to direct military action in key regions.
The speed is incredible.
It is. The jump in oil, the dip in stocks, the flight to safety, it shows how fast investors price in potential supply disruption, potential economic instability. And they do it even when the facts on the ground are messy or conflicting.
It's not just about what happened, but what could happen.
Precisely. The mere threat to a place like the Strait of Hormuz or just seeing major powers clash directly, that's enough to send shockwaves. The market doesn't wait for perfect information. It moves on perceived threat.
And maybe algorithms play a role in that speed.
Absolutely. Automated trading systems, big institutional funds, they re-rate risk based on headlines, sometimes unconfirmed reports, in microseconds. They're trying to front-run clear information.
It really hammers home how interconnected everything is, doesn't it? Something happens halfway across the world, and it can hit your retirement account almost instantly.
It really can.
Driven largely by that perception of risk, like you said, it's almost like the market has PTSD from past oil crises. Mention Hormuz, and it flinches.
That's a great way to put it. The market is like this global sensor, trying to pick up faint signals of trouble and price in future scenarios. The volatility wasn't just about the actual bombs, it was about that rapid reassessment of what might come next.
Okay, so as we wrap up this deep dive, we've seen this incredibly sharp, fast market reaction to the U.S.-Iran confrontation.
Right.
Energy, stocks, bonds, currencies, everything moved.
Driven by that perception of risk, the messy information flow, and the fear of wider conflict, not just the physical damage reported at the time.
So here's something for you to think about. In a world where these geopolitical events flare up and sometimes cool down so quickly, where the information is often murky,
What does the market's reaction, sometimes huge, sometimes muted, like with the ceasefire news, really tell us about global stability? And how much is perception versus reality driving economic certainty these days? How much is rational calculation, and how much is just that immediate, almost gut-level flight from the unknown?
a lot to chew on there. Thanks for joining us on the deep dive. We hope this breakdown gave you a clearer view of how geopolitics and global finance are tangled together.
Until next time.
Keep digging deeper.